Welcome. We're about to dive into what I think is the single most important tool for any accountant, aspiring or professional, the IFRS Conceptual Framework. And look, this isn't just about memorizing rules. It's about learning how to think like a pro.
So let's just kick things off with a huge question, one you're going to face in your exams and for your entire career. Picture this. You've got a really complex transaction, you've looked through all the standards, and there's no specific rule. What on earth do you do?
Well, here's your answer. You turn to the Conceptual Framework. You've got to think of this thing as the constitution for all of financial reporting. It gives you the fundamental principles to fall back on whenever those detailed laws and the specific standards just don't have an answer.
Okay, so how do we master this thing? Well, we're going to break it down into 4 key parts. First, we'll get into what makes financial data actually good and useful. Then, we'll nail down the definitions of the basic building blocks. After that, we'll talk about the real nitty-gritty, when and how you report things. And finally, we'll pull it all together so you can see how to think like a professional. Okay, first up, let's build a solid foundation. Before we can even think about recording a single number, we have to understand what gives financial information its value. What actually makes it useful for making decisions?
Right, so this slide splits these qualities into 2 really important groups. Over on the left, you've got the fundamental characteristics. Think of these as the absolute must-have non-negotiables. If your information doesn't have these, it's basically useless. Then, on the right, you have the enhancing qualities. These are the ones that take good information and make it truly great.
So let's break down that first fundamental quality, relevance. It sounds simple, but it's incredibly powerful. For information to be relevant, it has to be able to actually change someone's decision. If it doesn't matter to an investor or a lender, well, then it really has no business being in the financial statements.
And here's its partner, faithful representation. This means the numbers have to tell the truth about the economic reality of what happened. It's got to be complete, with nothing important left out. It needs to be neutral, so no bias, and it should be free from any significant error. It's all about telling the true story.
Now, once your information is relevant and faithfully represented, these 4 enhancers here just make it so much more powerful. Can you actually compare it to last year's numbers or to a competitor? Could someone else come in and verify it? Is the information ready in time to be useful? And is it presented in a way that people can actually understand it?
All right, so we know what makes for good information. Now let's get into defining the actual building blocks of the financial statements themselves.
Okay, the definition of an asset. It rests on 3 key pillars, and you have to remember all 3 of them. First, it has to be a present economic resource, not some potential future thing. Second, the company has to control it. They call the shots. And third, that control has to come from a past event. If even one of those is missing, it's not an asset. Simple as that.
And a liability? Well, it's pretty much the perfect mirror image. It's a present obligation to give up a resource. The company has a duty that it can't really get out of. And why does it have that duty? Because of something that's already happened.
Okay, so you've done the hard work. You've used the official definitions and you've identified an asset or a liability. Now for the next big question, and honestly, this is where a lot of marks are won or lost in an exam. When do you actually record it in the financial statements, and for how much?
The framework has this really strict rule. Think of it like a gatekeeper called the derecognition principle. You only get to record or recognize an item if putting it in the statements gives users information that is both relevant and a faithful representation. If recording it would actually be confusing or misleading, you just don't do it.
So once you decide to recognize something, you then have to put a number on it. Are you going to use historical cost? That's super reliable, but maybe not so relevant anymore. Or maybe fair value, what it's worth today. That's very relevant, but it can be a bit subjective. Or maybe value in use, where you look at future cash flows. Your choice really depends on which method gives the most useful information in that situation, and this trade-off is at the heart of so many debates in accounting.
So, we've gone through the what, the when, and the how of financial reporting. Now let's pull it all together and talk about the most important skill of all, professional judgment. This is really where we go from just knowing things to actually applying them, from theory to practice.
And here's the absolute crucial point. You are going to come across new, complicated transactions, things like digital assets or new sustainability metrics. When there's no specific IFRS standard to hold your hand, you don't just guess. You come right back to this framework. It's your #1 tool for navigating all those gray areas.
And here's how you do it, step by step. First, you have to look past the legal paperwork and figure out the economic substance. What is really going on here? Second, you check if there's a specific standard that applies. If there isn't, and only if there isn't, you move to step 3. You apply the framework's definitions and principles that we've been talking about. And finally, you come to a conclusion and you document your reasoning. Following this process makes your judgment professional and, really importantly, defensible.
I really want to leave you with this one thought. Anyone can learn to read a map, to follow the specific rules laid out in the standards. But a true professional, the kind of accountant that people want to hire, knows how to navigate when the map runs out. They understand the principles of direction. And that's exactly what the conceptual framework gives you. It teaches you how to navigate.